US bond market updates. The central banks of the US, Europe, and Japan take turns to bombard the foreign exchange market, and it's difficult to reduce the advantage of strong dollar. In the past week, financial markets have been extremely busy, with heavy information released by the central banks of the US, Europe, and Japan, and fluctuations in the US dollar, euro, and yen. Although the Fed is nearing the end of the interest rate hike cycle, interest rates are likely to remain high for a long time, and the economy is stronger than all Wall Street institutions expect, and the dollar index hit 102. The European Central Bank said it wanted to fight high inflation and worry about recession. The euro versus dollar fell back to 1.1. Bank of Japan, which was exposed to tightened monetary policy earlier, issued a policy statement on Friday that was less than expected. Adjusted the yield curve control policy, with flexibly controls the 10-year yield and reduced the impact of the function of the bond market by implementing a flexible yield curve control. However, the negative rate policy, base rate of -0.1 did not change, keeping the 10-year Japanese government bond yield around zero, and the US dollar versus Japanese yen rushed up to 140. The consensus expects the dollar to fall sharply in the short term, and Goldman Sachs have reduced the possibility of a US recession to 20%. The renminbi rebounded against the dollar to around 7.15, but in the current global context, the yuan is more likely to range bound in the third quarter. High interest rate in the US may remain high for a long time. The Fed announced its latest interest rate decision in the early hours of Thursday, raising interest rates by 25 basis points as scheduled, and the interest range came to 5.25% to 5.5%, and the median interest rate was at the highest level in 22 years, which was also the 11th interest rate hike in the past 12 meetings. The meeting statement was basically unchanged from June, but during the press conference, Fed Chairman Jerome Powell played it touchy. On the one hand, downplaying the possibility of a rate cut this year. On the other hand, not actively hinting at the possibility of further rate hikes. As a compromise, he's emphasizing the importance of data. Every future meeting will make decisions based on data. This also means that the inflation employment report ahead of the September meeting is crucial. Jerry Chen, a senior analyst at Gain Capital Group, told reporters that the consensus expectation is that July is a light interest rate hike. A rate cut is still early. Powell mentioned that at last week's Thursday's press conference that current interest rate is in the restrictive zone, because the nominal interest rate minus the market inflation expectations, that is the real interest rate, exceeds the neutral interest rate. If the inflation continues to decline in the future, the interest rate can return neutral or below. But he also mentioned that it may be difficult to cut interest rates in the first half of 2024, which also depend on the inflation data. The Fed is still committed to pulling inflation back to the 2% target. Powell also does not think inflation will fall back to 2% in 2024, but it does not have to fall back to 2% in starting of cutting interest rates. And will pay attention to the absolute levels of inflation at the speed of decline. Another reason for the Fed's caution is the rising commodities such as energy and food prices. Recently, oil prices have been broken above the resistance level above the 200-day moving average on the candlestick chart, indicating that the market believes the oil prices will move higher. Prices for food commodities are also rising amid concerns that Russia will continue to disrupt Ukraine's ability to deliver corn and wheat, and dissuade farmers from growing crops that cannot be sold. This once again boosts market expectations for future inflation, Jerry Chen said. It is worth mentioning that last Friday, the core PCE, which the Fed is most concerned about, announced an increase by 4.1% year-on-year, which is weaker than the expected 4.2%. Specifically, personal income grew by 0.3% versus expectation of 0.5%, while personal spending increased by 0.5%, beating expectations of 0.4%. Core inflation did not push the dollar index directly weaker, but remain about 101.4. This is partly because ECB is also starting to worry about a recession despite raising interest rates by 25 basis points. Whether the ECB can continue raising interest rates in September remains unclear, leading to a disappointment for Eurobonds who had earlier expected the ECB to be more hawkish than the Fed. A number of foreign exchange traders showed reporters as the dollar index once fell below 100 despite the sell-off in the previous weeks, but began to rebound in the past 2 weeks. For now, 101.4 area is a key support, and the US bulls are still trying to hit the 102 mark, but in the event of a reversal, downside support is around 99.59 to 99. We don't think the dollar will fall sharply, and the Fed will remain a certain degree of hawkish stance in the second half of the year, Jerry Chan said. ECB, plagued by inflation, is more worried about recession. The difficulty of a weakening a dollar is closely related to the euro, which accounts for nearly 60% of the dollar index. On the same day as the Fed's rate hike, the ECB also announced a 25 basis point rate hike, and ECB President Christine Lagarde says that interest rate will keep at a sufficiently restrictive level until inflation was reduced to the 2% target. We want to turn the tide of inflation or do whatever it takes to get there, she said. The main refinancing operation rate in the Eurozone hits 4.25%, the highest level in more than 20 years. However, unlike the strong economic momentum in the US, the ECB says the outlook for economic growth and inflation in the euro area remains highly uncertain. European versus US dollar recently retreated below 1.1. Europe faces the dilemma of high inflation and recession. While inflation in the Eurozone fell from 10.6% last year to 5.5% in June, the level of price growth varied from 1.9 in Spain, 9.7 in Czech Republic, and 6.7 in Germany. Lagarde says that the Russia-Ukrainian conflict may lead to broader geopolitical tensions, which may have an impact on trade and push up prices in the coming months. There are downsides to economic growth. She also said that after Russia withdrew from the Black Sea grain program, there may be momentum for further increases in energy and food prices. Calls for a pause in rate hikes have been coming. Dutch central bank governors Klaas Knot recently told foreign media, "I think it is necessary to raise interest rates in July. And as for after July, I mostly can only be said that it is possible but not inevitable." Senior economist at Big Debt Wealth Management Europe said. The reporter says the ECB interest rate hike in September is not a certainty. In any case, we believe that the September rate hike will be the last of the cycle, raising the deposit rate to 4%. This also means that the spread between Europe and the US will not narrow further, which will hit the expectation of the Euro bulls. European versus the US dollar is currently testing a key resistance zone around 1.1 to 1.102 to 1.105 range. The recent strength of US data further accelerated the decline of the euro. Bank of Japan may open up room for monetary policy to shift. Over the past week, the USD versus Japan currency has become the most popular symbol for foreign traders. Last week, the news of a possible pivot by the Bank of Japan led to a sharp fall in the dollar against the yen. It took the first step in policy adjustment, since it flexibly controls the yield of 10-year government bonds. That is, the existing fluctuation range of negative 0.5% to 3.5% will be used as a reference rather than a strict limit. And the central bank will continue to buy 10-year government bonds with a yield of 1% every working day. The move opens the door to further policy shift. After the Bank of Japan's decision, the 10-year bond yield rose to 0.55% after breaking through the upper limit, and the US versus the Japanese yen fell more than 1% in the short term, and then narrowed its decline. Against this background, the future trend of yen has become a focus of the market. Jerry Chan told reporters, "You need to pay attention to the key support area of 137.25 to 138.30. Which is the position of trending line and the 100-day moving average at the same time." That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.